Shares in Oracle down sharply today. The company's cloud sales disappointing investors, and a rise in AI spending has investors concerned that it's not translating as fast as they want into actual revenue. Our guest says the market seriously doubts Oracle's ability to become a major AI player. We're joined by David Sekera, U.S. Chief Market Strategist at Morningstar. David, thanks very much. If we look at Oracle stock, it had already tumbled from its highs and taking another pounding today.
Yeah, and I think when I look at Oracle, that and CoreWeave, I mean, these are really two of the prime examples that we've been pointing out about some of the buyer exhaustion that we're seeing in some of the AI stocks out there. Yeah, as you noted, I think the market really has some serious doubts about its ability to become a major AI player over time. And in fact, the stock is actually now well below where it was trading even before they made that major announcement a number of months ago that they were making such a huge transformation into their data center build out. So when I'm thinking about this stock going forward, I know management did reaffirm their guidance, so that's going to require really some pretty significant revenue acceleration in the second half of fiscal 2026. So in my mind, I think this is really going to be a show-me story for at least several quarters. I think the stock is going to have to go through a bottoming out process. I think what management really needs to do here is have an investor day, provide a much more detailed roadmap as far as how they're planning on financing the build-outs, providing a much greater detail for their free cash flow forecasts in order to help assuage a lot of the concerns in the debt markets, and really put out some better numbers as far as what the return on invested capital projections are going to be. And then I think it's going to take at least a couple of quarters of them just regularly executing on those plans, really to get market sentiment to come back on this name.
Adobe, apparently the market taking mixed signals from their numbers. They came out with a 2026 forecast that was seen as underwhelming, but their Q1 earnings beat expectations.
Well, and in fact, when I look at this name, according to our analysts, they've now beaten our own expectations here, for 6 quarters in a row. So this is one where I think, the market's really assuming that AI at the end of the day is going to end up eroding the value of their products. Our team thinks otherwise. When we're looking at annualized revenue and RPOs, both of those are still outgrowing revenue. I think that sets the company up for a good, 12 months, over the course of the next year. And when we think about, in this case, artificial intelligence, it's really going to be a tool that's going to end up helping them improve the economic value of their products and services over time. So this is another one where I think management really needs to do a much better job to really sway market opinion that their business, is not going to be overcome by AI. In fact, AI will actually be able to help them make more economically value-added products over time. Taking a look at our forecast, we're looking for 13.6, compound annual revenue growth over the next 5 years. Yet the stock is trading, well under 17 times our earnings estimate. So I think this is a good one. Do some added due diligence. Read through the stock analyst notes, but also spend some time, looking at the innovations that Adobe has displayed in their past couple of conferences. And this is one definitely in our mind to watch for 2026. 5-star rated stock. I think it's trading at about a 40% discount to our fair value.
You have some holiday stock picks for us. Starting up with Amazon. What attracts you here?
Well, of course, with Amazon, there's going to be a lot of Amazon boxes sitting on people's porch steps, coming into the holidays, thus far this year. And I think with Amazon, it's really much more than just their retail business. I think the market, significantly undervalues the advertising part of their business. Of course, they have AWS, huge total addressable market yet to come on that one. So a lot of growth still in the stock that we're looking for to, perform over the course of next year. Another one where I'm looking at, 5-year compound annual growth on the top line, over 10%, earnings growth, 13 to 14% over the next 5 years. And this is one that, rarely trades that much below our fair value, currently a 4-star rated stock.
You have another idea here, Mattel, the toy maker. What draws you to this name?
Well, this one's actually more of a swap recommendation than anything else. So last year for our holiday picks, we had recommended Hasbro. I believe that's up almost 50%. Since then, Mattel, very strong core brands, Barbie, Hot Wheels, Fisher-Price. We've had some problems with tariffs. We think that disruption is behind them. We're looking for double-digit growth here in the fourth quarter. We think inventory positions have been cleaned up. They're much more in line with holiday expectations. So we're looking for their turnaround efforts, to pay off in 2026, looking for some operating margin expansion. So this one is, currently a 4-star rated stock, trades almost a 20% discount to fair value, looks attractive to us.
And then finally, you've got a small cap REIT focused on shopping malls. Is it Macerich? Is that how they pronounce it?
It is, and that's a 4-star rated stock at a 24% discount to fair value. Pretty healthy dividend yield at 3.9%. They focus on Class A shopping malls, the higher quality shopping malls. Overall, I think the death of the shopping mall in the United States is really just greatly exaggerated. The shopping malls have done a great job changing up the portfolios. They're becoming much more experiential. You're seeing them putting in things other than purely just retail to drive foot traffic. Yet consumers still want that in-store experience as well. So this is one that I think will do well over time, especially because the real estate sector, in our view, is probably the most undervalued sector in the U.S. today. Trades at about a 10% discount to fair value. It's going to have some good tailwinds in 2026, ongoing easing monetary policy. We expect long-term interest rates to come down and looking for a rebound in the U.S. economy in the second half of next year.
Thank you very much, David, as ever.
Thank you.
David Sekera, U.S. Chief Market Strategist at Morningstar.